Thanks. Well, results off from Group 5 this morning show a slight dip in revenue to 11.3 billion rand for the year to June. Operating profit before adjustments up 10% at 877 million rand, and fully diluted headline earnings a share rose 10% to 561 cents. Joining me with more is CEO Mike Upton. Mike, thanks very much for coming in this afternoon.
Thanks for having me.
Mike, you say in the commentary that the main characteristics of the year were the global recession and the hiatus in public sector spending here in South Africa. The recession is over. Is infrastructure spending starting to come through yet, though?
The recession may be over, from a technical perspective, but obviously, we're a long play. We're also, a late entrant into some of these markets. So the real estate markets and, housing markets and so on are still very depressed. So, it hasn't come through for us yet.
So you really are still feeling recessionary conditions in the construction sector?
I think certainly in terms of the public sector side of it, that there's quite a lot of backlog of work that has to be done. We haven't been able to see the delivery of that really come to market yet, for a number of reasons. Finances, obviously, the capacity and the like. So it's been quite a difficult year.
Well, I mean, you point out particularly the construction materials division. In fact, you had to make an impairment adjustment to your construction materials division. That led to a 48% fall in earnings per share. Why was this necessary?
One has an asset there which is, the analogy is like a gold mine. If the gold price falls, the asset base under the ground obviously has a lower value. It's the same for quarries. So we had a look at where the market had come off from, in fact 30 to 40% down in volumes from a few years ago, and we had a very hard look at the way forward in terms of what infrastructure projects, the housing cycle and the like, to inform a decision as to what is the likely sort of returns on this asset. And we had no alternative but to impair that asset.
Of course, as you said, you're kind of late cycle, and we are seeing growth starting to pick up in South Africa. They're expecting growth north of 3% this year. When would you expect a normalization in divisions like construction materials?
We see a big driver for volumes in the quarries is actually the residential market. So we think it's 12 to 18 months away. We think the residential market will be the last out of the recession.
Well, having said that, you didn't do too badly last year at all. You've got 10% increase in diluted headline earnings a share. What sort of measures have you taken and do you continue to take to help counter some of the problems you're seeing in the sector at the moment?
We've done a lot of investment in people and systems to ensure we execute better. So I think we've certainly held on to a lot of the margin that we won at bid stage. I think one must also not ignore the fact that quite a lot of this work was multi-year, was won in a good period, so it's running out in terms of those large sort of projects which were around the 2010 period. That said, we've been quite aggressive and moving beyond that now, moving back into Africa, looking at the opportunities there. We have seen a recovery somewhat in the mining sector, so some of the African mining theme, which was weak in the year, has begun to show signs of order awards. So we think we're quite well placed for also the infrastructure spend as it will actually come through. The power side, water, the Eskom power stations will have to be accelerated in terms of the rate of build in time once they're able to fund those. So there's a lot of work to come. We're just going through this hiatus period now, which has been quite difficult to obviously predict in terms of giving forecasts.
How are you positioned for that work when it does come? And looking at Africa, when would you expect infrastructure spend to start picking up in Africa?
We're seeing Group 5 as very well positioned in the power sector, and particularly in the private power sector where we've built a number of power stations. We also see ourselves well positioned for heavy civils related to roads, infrastructure, ports and the like. In terms of Africa, we used to be quite focused on the resources sector, so that was mining, oil and gas and private power, but we're seeing a fundamental shift in the basic sort of strengths of some of those economies, which are resource rich, but now we're seeing a private enterprise beginning to invest in itself. So we're seeing opportunities for more of our businesses across Africa in the future.
And internationally, you are present in Dubai. You say you're seeing opportunities beyond Dubai, though. So how is your geographical split splitting out at this stage? We've
been based in Dubai for about 5 or 6 years. Obviously, with the meltdown, that became a market where it's a good place to live but not to work. There isn't much going on in terms of the type of work which we need to do. So we branched out into the region. We're looking at Jordan. We're working in Qatar, in Abu Dhabi. Our brand of execution in that region is not in the property or leisure market. It's really more basic infrastructure and in industrial projects.
Your total secured construction order book in 9.3 billion rand, that's down from 11.6 billion. Targeted pipeline, 119 billion rand. How much of that is in South Africa and how much of that is now further afield?
Interesting, our pipeline, which is really only a tool and not to be taken as gospel, it's really an indication of what we see out there in the marketplace. It is zero-based, but we've seen about a 50-50 split in international and local work. Now, a year or so ago, it was much more in favour of South Africa. So I suppose it informs the future order book will look more international by the very nature of that's what the pipeline mix is showing.
Just quickly, prospects for the year ahead. Of course, your full year dividend up 5%, so that seems quite cautious just given the space you're in at the moment.
We had to balance dividends with the reality. Obviously, at an earnings level, we were down given the repairment, but that's a non-cash item. So to be fair to shareholders, we stripped out the adjustments and we looked at a basic sort of dividend based on the underlying earnings of the business, which was under 4 times sort of cover, which comes out to the 137 cents, which I think is a good reflection of what's been and cautiously optimistic about the future.